Hello, good afternoon, class. I hope I'm audible. In the previous classes, we have already discussed from block one, the first four unit. Today, we'll be moving forward with unit five, that is treasury bills and call money market. Starting with the meaning and definition of treasury bill, it is also termed as T-bills. Basically, T-bills are short-term debt instruments that are issued by the Government of India to meet a temporary financial need wherever required. So basically, they are issued at a discount and redeemed at face value. I'll give an example so that would be more clear further. Also, the maturity period is less than 1 year for treasury bill. Talking about definition, so it could be framed like treasury bill is a risk-free, zero coupon, short-term money market instrument issued by the Government of India through RBI with maturities of 91 days, or it could be 182 days, or 364 days. Let's say we have a face value of rupees 1 lakh and the issue price is 97,000. So also the maturity amount is also 1 lakh. So the return amount will be lakh minus 97,000, that is 3,000, which is termed as discount. So this is how this T-bill work. Talking about the characteristics of treasury bills, I just now I have told that they have short-term maturity of 91, 182, and um, 364 days. Just take an example, like a bank is investing in 91 days T-bill for 3 months surplus fund. So this is how it works. Also, there is no interest is paid, and a profit is the difference between issue price and and the face value. Right? The example which I have given that the issue price was 97,000 and the face value was 1 lakh. So that is the profit. The minus value will be the difference value will be the profit. In this case, that is 3,000. Now, next, there is no periodic interest like bonds. We have periodic interest in bonds, no? So there are no periodic interest in these because of the tenure and it is its characteristics as well. Then it is guaranteed by government, so very safe and secure mode. Also, it is easily tradable in secondary market. Mutual funds are sell T-bills to meet redemption demands. It is one important thing about T-bills are they are auction based. So RBI conduct auction, weekly auctions are being conducted for treasury bills and they are issued electronically. So there are no physical certificates for treasury bills like we have for others. We do not have for treasury bills. No physical certificates are being issued. And a bank also invests to maintain their statutory requirement. Which is known as SLR compliances also. So these are the basic characteristics of a T-bill. Now, yeah, types of treasury bills. The first one is the regular treasury bill that is of 91 days. So basically, most liquid and commonly traded this one. Mostly used treasury bill is of 90 for 91 days. For example, bank invest in short-term needs. Then we have the second type is 182 days. So the duration of these bills are medium duration securities. Then we have 364 days T-bills that is highly maturity among T-bills offer slightly higher yield. So they are more beneficial because of the duration. Now the second type of treasury bills, these were the regular treasury bills, these duration ones. Now next we have cash management bills, which is known as CMBs, cash management bill. So basically they are introduced in the year 2010 and the maturity is less than 91 days. Like we have 30 days, 45 days, or 60 days, like that. So less than 91 days is the maturity time. Also, they are issued to meet government's temporary cash mismatches. So that is the second type of treasury bill, that is CMB, cash management bill. Now, talking about some advantages and disadvantages of treasury bills. So the very first advantage is that they are a risk-free investment. Why? Because there are no zero default risk is there. Also, they are backed by the government of India. So that is the reason they are a risk-free investment. Then they high liquidity is there. That is that can be easily bought and sold. So that is the next advantage. Then we have short-term investment option is available. So they are mostly suitable for banks, mutual funds, or corporates. So anybody can easily use them. And also there are no TDS. In TDS are basically the tax deductions, right? So returns, whatever returns you are getting, they are not subject to tax deduction. No tax will be deducted from them. Then we have a benchmark for other rates. So they act as reference for commercial papers and call money rates. Also useful for monetary policy. So RBI uses treasury bills in open market operations known as OMOs. Uh, let's say if 91-day treasury bill yield rise from 6% to 7%, so commercial paper rates will also rise in that case. So these were the basic advantages or the good points about treasury bills. Talking about the disadvantages or the cons of treasury bills. Yeah. So low returns are there, though they are very secure, safe, and backed by government. But the major drawback is the return rate is very low because they are risk free. The only reason. Then there is a risk of inflation. So if inflation high increases T-bill yield, so real return becomes negative. Then reinvestment risk is also there. So investor must invest frequently as maturities are very short. Then they are not suitable for a long-term investors. That is, maturity is less than 1 year. So those who are interested in long-term investment, these bills are not a good option for them because of the duration. Then talking about the opportunity cost, so investor may miss higher return from equity or corporate bond. So these are the very few disadvantages of T-bills. Now, next thing over here we have call money market. Yeah. So call money market is a segment of money market where banks and financial institutions they borrow and lend funds overnight or for let's say 2 to 14 days. Also, call money is being borrowed for 1 day. That is overnight. Also, they are being borrowed. Then talking about notice money, so they are borrowed for 2 to 14 days, and the interest rate is called call rate, CLL, call rate. Let's take an example where let's say State Bank of India borrows rupees 200 crore overnight from some other private bank, let's say HDFC Bank, at some rate like 5.8% interest to meet its CRR requirement. So overnightly they are borrowing money. So that is termed as call money. So who are the participants in call money market? The very first one is the borrowers. So they are the scheduled commercial banks and the primary dealers. So direct people are not involved in this call money market thing. Then the second participant is the lenders. So under lenders, we have commercial banks, cooperative banks, private dealers are there, also financial institutions like NABARD or SIDBI, Exim Bank. So they all come under financial institutions under lenders. Also, not allowed as borrowers. So, under the category of borrowers who are not allowed, mutual funds and insurance company, but they can lend indirectly, they can lend, but directly they cannot be uh, allowed as borrowers. Yeah. So NABARD, acha, not NABARD. So coming to the next thing, advantages of call money market. Well, it help maintain daily liquidity. Like example, ICICI Bank borrows overnight to maintain CRR. Then it has efficient utilization of surplus fund. So surplus bank lend money instead of keeping idle cash. Then a foundation of for monetary policy. So call rate quickly reacts to RBI repo rate changes. Also, it provides a flexibility. The funds available immediately and they are repayable on the very next day. Also, indicator of liquidity condition. So when we have high call rates, so liquidity will be in shortage. Whereas when we have falling call rates, so liquidity will be in surplus. So that is the indicator of liquidity condition. What? This call money. Also, yeah, they are safe to very short maturity, which I have already discussed. That overnight lending reduces risk. Acha, there are few questions or short answers which could come under uh, this unit, like what are treasury bills? One liner question could come from this unit, like what are treasury bills? So you can easy tell them ki they are short term government securities issued at a discount and redeemed at face value. Then a short answer could come like types of T bills you need to tell, and also there are two types. First on the maturity date, and the second one is cash management bill. Then you could be asked about call meaning of call money and who are the participants in call money market. So from this unit, these kind of questions could come up. So be ready with these things. Okay. Now we'll move on to our next unit. This unit 5 is very short and very easy as also. Nothing much is there. Yeah, give me a moment now, just a minute, then we'll start unit 6. Yeah, coming to 1 minute. Sixth unit. Yeah. In unit 6,
Ma'am,
we have yes.
ma'am, is this core subject or elective subject?
Uh, this is, wait a minute.
Actually, it is Commerce 12 itself only, no?
Yeah, Commerce 12, this is discipline specific elective course, financial markets.
Financial market. Okay.
Yeah.
Okay, ma'am. Thank you. Sorry, ma'am.
What happened?
Actually, I was looking forward for company law.
Yeah, yes. Last week also there were some issues. You check in your group,
Yeah, ma'am.
WhatsApp group or the concerned person for.
Yeah, ma'am. Fine. This is elective, no, ma'am?
Yeah, I believe.
Okay.
Yeah, talking about Unit 6. In Unit 6, we have commercial papers and certificate of deposit. So, the money market consists of short-term financial instruments that provide liquidity to borrowers as well as to investors. So there are two important unsecured instruments in these market. These two are CP and CD, that is commercial papers and certificate of deposit. Talking about commercial papers, they are a short-term, unsecured promissory note issued by companies to make working capital needs. That is commercial papers. And CD, that is certificate of deposit, they are a negotiable term deposit issued by banks and select financial institutions offering a fixed return for a specific period. So both instrument help maintain short-term liquidity in the financial system. What are the two instruments? The commercial paper termed as CP and certificate of deposit, that is CD. So coming to the first one, let's talk about the features of commercial papers. Well, the very first thing is it is an unsecured instrument. That means CP are not backed by collaterals. Only top rated companies can issue them. So it is an unsecured instrument, commercial papers. Then the second thing is they have short term maturity. So short term maturity will range from 7 days to 1 year, or as per RBI guidelines. Then they are issued at a discount. So CP are issued below face value. Example, 97 rupees for 100 rupees CP and redeemed at par. Then the next thing about CP is they are tradable. So CP are negotiable and can be traded in the secondary market. Acha, talking about eligibility criteria for CP, so issuer must have minimum credit rating such as they need to have CRISIL A1 plus or ICRA A1 plus. These are the ratings. So they need to have these top rated companies need to have minimum credit rating to have to issue these commercial papers. Now, denominations, so issued, the denominations are being issued in multiples of rupees 5 lakhs only. Okay. Then they are issued in demat form. So since 2001, CP are issued only in electronic form, that is demat form. Again, no physical certificates, no physical documents are being issued for this. Then they are issued by corporates and FIs. So that FI means financial institutions. So they includes company, the primary dealers, and financial institutions. Let's say like for Reliance Industry may issue CP worth rupees 1 crore to meet short-term working capital need. And investors like mutual funds or banks buy it at a discount and earn the difference at maturity. So this is how CP works. Now, who are the participants in commercial paper market? There are two participants. The first one is the issuer and second one is the investor. So under issuer, we have large corporates like big companies. Tata Steel is there, Infosys is there, Reliance is there. Then financial institutions comes under this category. Also primary dealers and all India development financial institutions. They all come under the category of issuers. Then uh, hmm, second participant is the investor. So investors are banks, then we have mutual funds, insurance companies, corporate treasuries, also HNIs. HNIs are high net worth individuals, the people with having a high net, matlab they have a high net worth. So those also come under this. Then also sometimes provident funds are also being permitted to termed as investors. So they all come under the category of investors. Yeah. Okay. Now we'll discuss about some advantages of CP. So there are these advantages are being divided again. For investors, there are certain advantages, and for uh, issuers, there are certain advantages. Now, the first we will discuss first about issuers. So they are low cost of funds. So CP interest cost is usually lower than the bank loans. Then they are quick and flexible. That is, they are easy to issue and redeem. Then no collateral is required. So helpful for cash rich but temporary liquidity or short companies. Now, talking about in terms of investors, they are higher return compared to bank deposits. Then high liquidity due to short-term maturity and low risk because only highly rated companies can issue CP. So this was all about CP. Now, next thing we have under this unit is CD. We'll discuss this certificate of deposit. So, a certificate of deposit is a negotiable money market instrument that are issued by banks and select financial institution in form of promissory note. So, it is a time deposit with a specified maturity and fixed interest rates are there. Let's say SBI issue a 6 month CD at 7% interest to raise rupees 500 crore for short-term liquidity. Or you can say a mutual fund purchase these CDs to earn safe short-term returns. So that is certificate of deposit. Again, there are talking about the participants of deposit market. There are two participants. The one is issuer and the investor. So under issuer category, we have scheduled commercial banks. Then we have selected financial institutions like NABARD, SIDBI, Exim Bank. And under investor category, there are corporates are there, mutual funds, insurance companies. Then sometimes we have provident and pension funds and banks. Also, interbank transaction is also been allowed here. So these are the participants of CD, that is certificate of deposit market. Next, we have features. We'll discuss features of certificate of deposit. So very first feature is they are issued at a discount. Just like CP, commercial paper, they are also issued at discount and they are redeemed at face value. Now, the maturity paper, period over here for banks, it is 7 days to 1 year. And for financial institutions, it is from 1 year to 3 years. This is the maturity period. Then they are negotiable and freely transferable instrument, and they are issued in dematerialized form. Like physical CDs are now very rare, so only electronic form is available. Then a minimum size, that is rupees 1 lakh and its multiple. So whereas in commercial papers, the denomination was the multiple of 5 lakh, whereas in CP, the denomination is in multiple of rupees 1 lakh. So they have a minimum size. Next, it is a low risk instrument. So because they are issued by bank, financial institution, they are low risk instruments. Also, they are non-renewable. So fresh CD must be issued after maturity only. Now, they give high interest rates, then saving accounts. That is very um, good feature of CD. And uh, as discussed previously, that no premature withdrawal is there. So unlike bank deposits, CDs cannot be withdrawn earlier. So at the time of maturity only, they are being withdrawn. Now, few advantages. Yeah, few advantages of deposits. Again, divided into categories for issuers and for the investors. Yeah, for issuers, let's say it is a lower cost of fund, that is CP interest cost is usually lower than bank loans. And they are, yeah, then they helps bank manage short-term liquidity. So bank issues CDs when they need fund urgently. Also, they are a stable source of fund. So because CD cannot be withdrawn before maturity, they act as the stable source of funds for issuers. Then talking about flexibility, so bank issue CD as per liquidity conditions. So flexibility is also there. Now, when we talk about advantages in terms for investors, so the very first thing is it is safe investment because it is regulated by banks. Then higher returns than saving accounts are there, and short-term deposits, short-term maturity is there. So it help investor manage temporary surplus funds. Also, they are tradable, so they can be sold in secondary market for liquidity. So these are the advantages of CD, that is certificate of deposit. Now coming to the last point, that is history of certificate of deposit in India. Well, these certificate of deposit, yeah, they are been introduced by Reserve Bank of India in the year 1989, basically to widen the range of money market instruments. And what was the objective of to introduce these was to provide bank a new instrument for funding needs. Then in the year 1992, these financial instruments were allowed to issue directly. They were allowed to issue CDs, that is certificate of deposit. And in the year 2002 onwards, certificate of deposit shifted to dematerialized, that is demot form, electronic form. Now, CDs have become a major short-term investment tool for mutual funds as well as for corporates. Now, from this unit, short answers could come where you would be asked to describe the features of CP or CD or advantages of CP or CD, or a long answer could come where you have to write down comparison between the CP and CD. So on what basis you will write the comparison, the answer I'll let you know. So first of all, you just make a column and write down the features. Features of what? First CP and then CD. The first feature is they are issued by. So who issues CP? Corporate or financial institutions issued CP. Whereas CD, they are issued by banks as well as financial institutions. Then, talking about the second feature, you can write in black or in bold that it is a security. So, CP is unsecured, whereas CD is secured by bank reputation. That is the second feature. Like that, you can write. Then, you write about maturity. So, maturity is for CP, the maturity is 7 days to 1 year, whereas for CD, for banks, it is 7 days to 1 year, and for financial institution, it is up to 3 years. Now, the fourth feature, write down form. So, CP are only in DMAT only, But CD is DMAT mostly. That means physical document is also available, but mostly DMAT works in CD. Then purpose. So the purpose of CP is working capital, whereas purpose of CD is liquidity management. Then talking about risk, which is important point. So moderate risk is there, and CD low risk are there because they are backed by banks. Then talking about returns, CP gives higher returns, whereas CD gives medium returns. So this is how you can frame a long answer, which might come as a comparative or write a comparison between commercial papers and certificates of deposit. Like that, you can write. Otherwise, short answers would come, and this is the only thing which you can prepare easily and write down answer easily, where you study the comparison. Am I clear till now? Yes, no, anything? Okay, just give me a minute. I'll start with the next unit. Okay. Our next unit is, yeah, Unit 7, Equity Market. Okay. Talking about equity market. Well, the equity market is also called as a stock market. So it is basically a platform where shares of companies are issued and traded. Then they have two major yeah, they have two major segment. The first segment is termed as primary market, and the second segment is secondary market. So, primary market is where new securities are issued for first time, like IPOs are there, initial public offering, or FPOs are there. So that is primary market. Then we have the second market, which is known as secondary market. So where existing securities are bought and sold among investors through stock exchange, that is NSE or BSEs. So primary market and
Mhm.
secondary market. Two major segments are there in equity markets. Also, the equity market plays a crucial role in capital formation, liquidity, price discovery, as well as in economic growth. So that is the basic about equity market.
Market.
Now, if we talk about functions of equity market, the very first thing is mobilization of savings. So it converts household saving into productive investment, the very first function. That is mobilization of savings. Then it helps in capital formation. So it enables company to raise long-term funds for expansion. So it helps in capital formation, second thing. Third is liquidity to investors. So shares can be bought and sold easily in stock exchanges. So it provide liquidity to investors because the shares can easily be bought and sold here. Then I said about price discovery. So price discovery is basically market determines share price through demand and supply. So that is price determination. Then we have risk distribution. So investor can diversify their portfolio by investing in different sectors. Then a very important function of equity market is it promote corporate governance. So a listed company must follow SEBI rules, disclosures as well as compliances. So it promote corporate governance as well. So everything which the borrowing or the selling, whatever it happening in the equity market, so the compliance is there. So no malpractices are there. Nobody can fraud you there. That is, it promotes corporate governance. Then it also encourages investment culture. So it motivates public participation in financial market. Then it is an economic indicator. So how market indices like Nifty and Sensex, by looking at them, it reflects economic condition, what is happening, right? What rates are rising or falling, or what is the current economic situation. So by this these they can be figured out easily. So these are the basic functions of equity market. Now, one minute. Yeah. Next thing is methods of issue. So companies raise fund in primary market using um, certain issues. So the very first issue is public issue. That is IPOs. That is initial public offer. So first time issue of shares to the public. Then we have FPOs, that is further public offer. So these are the additional shares by an already listed companies. So those who have already given IPOs, now if they have to uh, issue more shares, so that will be issued in the form of FPO, that is further public offer. That is the first one, that is public issue. Then we have rights issue. So it shares offered to existing shareholders in proportion to their holdings. That is rights issue. Then we have bonus issue. So free shares issued to existing shareholders from accumulated profit. Then we have private placement. So offering shares to a select group of investors only. So these groups could be banks or mutual funds. Then we have qualified institutional placement, that is known as QIP, qualified institutional placement. So they issue only to QIBs only, so qualified institutional buyers only. They issue to them only. So many companies raise funds through QIPs to avoid lengthy procedures. Then there is one thing which is OFS, that is offer for sale. So that is the promoters or the government sell shares to the public via stock exchange platform. Example is government OFS is Coal India, in Coal India. So that is OFS. Now, who are the operators in new issue market? We'll talk about primary market. So the first one is the merchant bankers or the lead managers. So they manage the entire issue. They prepare prospectus as well as they follow coordination. Then there are underwriters. So the underwriters basically guarantee the sale of shares, purchase unsubscribed portions. So those are underwriters. Then we have RTAs. These are the registrars and the transfer agents. So they handle applications, allotments, refunds, all those things are uh, taken care by RTAs. Then there are brokers to the issue. So market the issue and collect applications. Then there are bankers to the issue. First was brokers to the issue, then we have bankers to the issue. So they collect application, bankers, they collect application money and they handle funds. Then there are advertising agencies, so they promote the public issue. Then we have auditors and legal advisors. They ensure compliances as well as transparency. So these are the operators in new money market. A lot of operators are there in new issue markets. Now, what are the advantages of new issue markets? Let's talk in terms of uh, key factors. The first for companies, then for investors, and importantly for economy. Coming to the first one, for companies, it raises long-term capital. Then no repayment burden is there. That is, equity is not repaid like loans. Then it enhances corporate image and visibility. Also, it helps in expansion, modernization, and diversification as well. Now, the second lookout is for investors. So there are chances to invest at the lower price, that is IPO price. Then possible listing gains are there. Also, access to new and high growth companies are there. And the last one is for economy. So it promote industrial development. It encourages financial inclusion as well as public participation. So these are the uh, advantages to new issue market. Now we'll talk about limitations of new issue market. Give me a moment, please. Yeah. Yeah, the limitation of a new issue market. So the first limitation is the higher cost. Well, issue management, advertising, and underwriting, a lot of costs are being incurred in new issue market. So because of all these things, the cost is higher. Then the procedures are very time taking. So due to regulatory checks and documentation, the procedure gets very lengthy and time consuming. Next limitation is condition affect success. So bad market segment can spoil a good issue. So if at all issue is going in a good condition, but overall market condition is not good, so this that is going to directly affect that issue. It's going to spoil it. Right. Then there are risk for investors. So not all IPO give listing gains, some underperforms as well. Also, there is a possibility of overvaluation. So some companies prices shares too high. So possibility of overvaluation is also there, and it is an important limitation under new issue market. Then we have developments in the primary market. So the very first one is online IPO application, that is known as ASBA. That is application supported by blocked amount increases transparency. Then introduction of a QIP, that is faster and simpler way of companies to raise fund, QIPs. Then we have another development, that is book building process has been introduced. So more accurate price discovery based on investor demand is there. Then we have growth of SME IPO platform. So it helps small and medium enterprises to raise capital for them. Now, very important development is that is reduction in listing time. So from 21 days, it has become to 3 days. And there is one channel which is termed as T+3 listing. So through that, the listing time has been reduced to only 3 days now. Now, the last development is strengthening SEBI regulations. So it has improved investor protection as well as discourse. These are the developments under primary market. Now we have secondary market, 7.8. Well, the secondary market refers to the organized exchange where existing securities are traded after their initial issue. Examples, very good examples are NSE and BSE, that is National Stock Exchange and Bombay Stock Exchange. So investor buy and sell shares through stockbroker. So what happens in secondary market refers to the organized exchange where existing securities are traded after their initial issue. Issue, the things are happening in primary market. So after that, when the trade is happening, that will happen in secondary market. In that is in NSE and BSE. Okay. Now, coming to the functions of stock exchanges, the very first thing is it provide liquidity. So investor can convert share into cash anytime. Then price discovery. Similarly, we have fair price determined through supply and demand. Then safety and regulation. So it is governed by SEBI, so which obviously ensures transparency. Now, transaction efficiency is their advanced electronic trading system, which ensures fast transactions. Also, mobilization of capital. So it encourages investments in productive sectors and a dissemination of information, that is it's provide market data, price indices, as well as company information and investor protection as well. So surveillance mechanism prevent manipulation. And the important one, it promotes investment culture. So these are the functions of stock exchanges. Now, coming to organization of stock exchanges in India. So India has two types of stock exchanges. The first one is recognized stock exchanges and ownership structure is there. So under recognized stock exchanges, we have NSE, BSE, MSE, CSE, etc. And under ownership structure, we have mutual organizations. Previously, it was termed as mutual organizations, but now it is termed as demutualized. That is ownership, management, trading memberships are separate. Now, talking about the structure, so governing board is there, which consists of directors and SEBI nominees. Then we have executive team for them, in which they are CEO and COOs are there. Then various departments fall under this, like a department like listing department, trading, surveillance, then clearing and settlement department. So various departments are there. Yeah. Coming to listing and procedures. Um, yeah. Meaning of listing and procedure. So listing means the admission of securities to dealing on a stock exchange. Now, what are the benefits of listing? So it enhances visibility and reputation. It provides liquidity, also better valuation, and an access to a wider investor base. And how this listing work, we'll see in the procedure of listing. Well, submission of application to stock exchange, the first thing. Then submission of draft prospectus to SEBI. Then we have to get approval from SEBI. Then public issue is there, that is IPO. Then allotment of share happens. Then completion of documentation is done, and then listing and commencement of trading has been done. So how listing is being done? One Yeah, first of all, a proper application is being submitted to stock exchange. Then submission of draft prospectus is being done to SEBI. Then we need to then approval from SEBI is required. Then only you get public issue, that is initial public offering you get. After IPO, the shares are being allotted, and the proper documentation has been completed, and after that the listing is being done and trading starts. So this is how the process of listing happens. Now, that was about listing and procedure. Next thing is players in the secondary market. Well, who are the players? First of all, we have stockbrokers as well as sub brokers are there. Then retail investors as well as institutional investors. Institutional investors means the corporate funds and insurance firms. They comes under institutional investors. Then market makers are there. For depositories like NSDL, CDSL are there depositories. Then SEBI is there, which plays as regulator. Also, DPs, that is depository participants are there. So these are the participants in secondary market. Now, how trading and settlement procedure works here. So first of all, uh, what happens? The very first thing is order is being placed. So placing of order. So investor place buy or sell order through brokers. Then order matching is done. So order matches on exchange platform on NSE and BSE. So orders are being matched there. Then you get trade confirmation. After that comes clearing. So clearing is like obligation determined by clearing corporation. Then comes settlement, right? So India follows T plus one settlement cycle since January 2023. So T plus one cycle is trade cycle T, and settlement next working day. T plus one, that is trade day plus 1 day as settlement next working day. Okay, trade day plus one. Then we have demat transfer. So share move electronically from sellers demat to buyers demat, right? And finally, funds transfer, that is buyer's money transfer to seller. So this is how the process of trading and settlement works. Now, the last thing over here, we have development in the secondary market. So the very first thing is starting from 1996 onwards, dematerializations happens. That is physical share replaced by demat shares. That is dematerialization. Then online trading platforms came into existence like Zerodha, Grow, Upstock. Uh, so, so they have simplified stock trading. Then T plus one settlement cycle came into existence. That is faster settlement system globally. Then algorithmic and high frequency trading came into existence, which is known as HFT. Also, a very good surveillance system is there, that is real time monitoring to detect any manipulation. That is known as surveillance system. Also, investor friendly reforms are being made. So, who are the regulator? Basically, SEBI is the regulator here. The SEBI simplified KYCs. Also, lower transaction costs are being issued by them. Also, SME trading platform. So these are the basic developments in the secondary market. So with this, we are done with our unit 7. That's all for today's class. We won't be able to finish if I start the next class today. So yeah, in the next class, we will start our unit 8. We'll talk about debt market, also known as bond market or fixed income market in the next class. And regarding the notes, I'm placing my email ID in the chat box. Please put me
Okay.
a message so that these notes I'll share you through email, and you please forward the notes to your WhatsApp groups to other students as well. I hope I'm clear. Still 2 minutes are there. If you have any doubt, you can put in the chat box.
Ma'am, T plus 2 means 2 days timing, ma'am. Share allotted in 2 days.
No, no. The,
The
sorry, what are you
settlement
asking?
days in generally T plus 2
T plus
means,
one.
ma'am, T plus 1.
Yeah, T plus one.
T means trade, ma'am.
Trade day.
Trade date.
And plus one is the next working day.
Next working.
If
Okay.
Sunday is falling or if it is a holiday, then one that day will not be included in that day.
Okay. Next following day.
Yeah, next
Very lengthy, ma'am. Chapters. Okay, ma'am. Bye.
Yeah, okay, bye. Take care. We'll meet on next Sunday.
Okay, ma'am. Thank you, ma'am.
You're welcome. Bye.